Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. Ice raw sugar in New York. The core of the bullish support here for the market during summer going to November had been the lower time of the December 2020 to April 2021 bullish shift pitchfork, currently at 1809. I've highlighted the whole pitchfork in dark blue so you can visualize the tines more clearly as it become more important over time. This lower time caused some very prominent rises, with the market gapping higher and pushing up over all the moving averages, plus the significant February 2021 high at 1894, the congestion at 1964, and finally the middle time of the same big bullish shift pitchfork, and that's currently 2034. However, prices peaked mid-November at the congestion at 2047, last seen capping the market back in April. This led to some sideways action, which included a pipe bottom in late November, based around the congestion at 1964. By late December, this congestion was enough to be a bullish halfway hesitation, and prices managed to reach the primary target easily in the 2050 area, but were not able to manage to the secondary harder to reach target up at 22 even. The peak happened on the last session before Christmas with an indecisive spinning top right at the top of the market, a sign of things to come, I think. The fall thereafter punched down through the middle time and all the way down to the combination of the rising medium moving average, currently 1905, and the then barely rising, or even now barely rising, long moving average, currently 1892. These together, coincidentally, were just happening to be making a golden cross at the same time at the start of January, causing prices to revert back upwards to the supposed comfort of the congestion at 1964. This has left us with an interesting situation. It can be perceived that this subsequent rally could be the beginnings of the formation of a second shoulder in a November 22 to date possible head and shoulders top. It is way too early to call it that, but the opportunity to create such a pattern is indeed there, especially with the possible pipe top made at the start of last week. Alternatively, it could be something else completely, such as another bullish halfway hesitation. In either case, we would need some more price action development to take place to ascertain what is the next pattern. Ice Europe white sugar in London. Changeovers produce some strange events here. Since mid-September, this market has been dominated by the one action, the changeover gap that happened back then. Now, one can say a lot of things about what happened beforehand, but that changeover gap, seen here on the continuous daily chart, is really big. There has been a number of attempts since to try and fill it, but each time the market stretched higher, it ran short because of another changeover. Such a move was most recently seen in December last year. Since that gap lower in December, prices have fallen down to the lower time, currently at 535 even, of the late October to late November 2022 bullish shift pitchfork, where the action at the time created a pipe bottom over the first proper weekend of 2023 before moving higher. I've highlighted this bullish shift pitchfork in dark blue on my daily chart to aid in the conversation. Yet the move higher was stymied 2 weeks ago by a shooting star pattern, type 1 bearish. Interestingly, this bearish pattern had a limited follow-on lower. I suspect this was due to the rising lower time impacting on the approach of the market. And 2 Fridays ago, we had a combined key reversal up and bullish engulfing pattern. This action led prices to open, gap open is a more accurate description, after yet another changeover, this time over all the moving averages and with seemingly little in the way topside bar its own self-confidence until the middle time, currently at 566.40, of the same bullish shift pitchfork and the February 2017 high at 565. And that is what we saw. A move up by an unusual key reversal up to just short of these resistances last Tuesday, followed by an immediate countering bearish double and a possible pipe top being created. Prices have since threaded their way through the mess of the moving averages and a March 2017 high at 548.80 to end up roughly where the median is for the last 2 weeks. Now the key question here is whether the bullish shift pitchfork will hold up prices, specifically the lower time. If it doesn't, and by mid-March the lower time will intersect with the March 2017 high, well, we'll have to discard it and utilize the one support zone that we know that works, and that is the 522.80 to 509.50 widespread congestion that starts with the 50% Fibonacci line of the July 2021 to September 2022 move at 522.80. It still leaves a huge changeover gap open from September last year, which is from where I started this commentary. I'm not impressed when my commentary goes round in such a circular fashion. Sugar white premium spread. We are well into the new year and this chart continues to be very, very colourful. Many things are going on, all at the same time. Okay, so I'd previously spoken about two big picture items seen here on this weekly chart. We had the recurring big old bullish Andrews pitchfork from 2019 to 2021, highlighted in dark blue on my daily chart, with the market currently in between the lower time below, currently 86 3/4, and the middle time above, currently 161. Though this pitchfork had been breached in the past, it still continues to show the overall major bullish angle of attack. Next, we also have an ascending expanding wedge pattern, highlighted in bright red trend lines above the market. This was formed between mid-April to late November last year. Currently it's 156 to right off the top of my weekly chart. To me, it was and still is not the best looking of such wedge patterns, but it is also still there. And it comes with all the possibilities such a pattern can invoke. A sub-point to this had been the monthly key reversal down we saw in September. Despite what has happened since, which seems to sort of justify this action, please still take any ideas based on this monthly key reversal with a huge pinch of salt, as an earlier monthly key reversal down we saw in July did not work out so well. The most recent activity has been the small reactionary move back up started at the end of November last year, after an earlier huge counter-to-counter weekly key reversal down. What was interesting about the action thereabouts has been the recent capping carried out by the neckline of the big June 2021 to May 2022 reverse head and shoulders pattern, which I've highlighted in bright green, and that's currently at 145 3/4. Interestingly, recent action justified part of my commentary made something like 11 weeks ago, and I quote, "Below the long moving average, that's currently 126.5, we have really nothing much until the late April to early May congestion based around the lesser Fibonacci lines at 104.5 and 107.5. The core of this congestion is in the 102 to 107 zone." End of quote. I continued and I quote, "So of all these actions and points, it's time to look at possible targets below for the break below the ascending expanding wedge pattern. Thus, a potential target X on the downside would be in the 102 even zone, just below the late April to early May congestion." End of quote. 10 weeks ago, prices dropped down to reach the primary target at 102. They actually ended up quite a way below it due to overrunning. However, I was mindful back then and since that we were approaching the lower time below of the big 2019 to 2021 bullish Andrews pitchfork, as well as the neckline of the February to September 2020 head and shoulders top, currently 75 3/4, which is a little below the lower time now and is highlighted in pink. I suspected some 6 weeks ago that this neckline might end up being important, hence the highlighting. In case you're interested, the secondary harder reach target X1 for the expanding wedge pattern, well, that's way down in the 46 3/4 zone. This brings up last week's action, which was a second consecutive combined indecisive spinning top, but this time also a bearish dark cloud cover pattern type. Once again, it'll be interesting to see if there is any sort of follow through lower this week. Now, 5 weeks ago I said the following, and I quote, "It has crossed my mind that perhaps, just perhaps, the action since the middle of November might be building up to be a possible bear flag or bearish halfway hesitation. It's early yet to really even think this, but I just wish to lodge the thought in your mind in case it turns out to be something." End of quote. Well, things have moved on since then, and the danger from such a pattern has grown. grown for another week. The market therefore deserves to be watched carefully, just in case we do see a break lower and the opportunity for a possible big bear flag.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.